Right, number 3, volatility based. I put here ATR, which is your average true range. So you can use this on a daily or on an intraday chart. Really good way of trading this one. You can basically say to yourself, listen, let's look at a 5-minute chart example. I'm going to trade off a 5-minute chart, and I want to look and see what the average true range, the average bar range, or the average price distance moved, if you like, want to put it like that, in a 5-minute period of the intraday trading. Now that could be, let's say it's 30 ticks, right? So now you've got a choice, and you can say, well, that's the average. Maybe if I take my stop and do 1.5 times that, so I do 1.5 times and I get myself 45, or maybe I go 2 times that or 3 times that, whatever you want to do depending on what you're looking for. If perhaps you're looking for a scalper type of trade in 5 minutes, you probably wouldn't be scalping, but if you're looking for a bit of more of a short-term trade, you want to dial that down a bit. If you're looking to, let's use an example here. I haven't really got room on the board to do it. I'll try and squeeze it in. Hopefully you guys can see it. Let me use a blue pen because I know it comes up better on the screen. Let's say we were looking for, this kind of move. It'd been lunchtime, it's come down, and we just think, listen, this is the bottom, this is the low of the day. Some point here, we want to get involved. Our theory is that we're going to push back up, we're going to close at highs, we might get a second day of follow through. So we're looking for a 2 or 3 day trade here. And we've kind of got the area we want to get involved in. We don't want to finesse it too much. We want to give it a little bit of room because, as I say, this is a 2 or 3 day trade. There's no point using a 10-tick stop because our target's going to be maybe 250 points on this Dow trade, oil trade, whatever it may be. So we say to ourselves, listen, the ATR on the 5 minutes is 30 ticks. I need to give myself, actually, I don't know what market would be 30 ticks. That sounds a little bit high, doesn't it? It'd be something more like, let's stick with 30 ticks example, it doesn't matter. 30 ticks, and we'll say, listen, we're going to use a 3 times ATR for this because we're prepared to give it a little bit of room. It's in a downtrend. We haven't got a specific premise base because there's no real low. Maybe we're at the low, but we feel that for whatever reason, I'm not going into the setup here, we feel that is the low of the day, but we're going to give it a bit more room. We're not naive enough to believe that we can nail that low right on the button. We know there's going to perhaps be a little bit of overshoot. So that will come very handy, ATR times 3, and then it gets to that because we've still got a specific price point, but it's a way of us calculating that stop loss. Say on a daily, you can say on a daily, listen, the average daily range is X, so I may well, even if I'm trading and entering intraday, I may well say to myself, okay, well, I'll give myself a full day's range on it over how many days that takes or not to give myself a little bit of room because I know that I'm not going to be accurate enough. So I guess a good way of looking at this ATR is its noise. You're trying, again, the same premise is you're trying to have your stop as narrow as you possibly can while still allowing for the noise. So that's ATR. Now the second one in the volatility base is the largest range of a candle. Very, very similar to ATR, but instead of having the average range, you're taking the maximum range you've had in a certain period. So that might be intraday. What's the largest candle range in a 5 minute I've had intraday? If that's 30 ticks, I may want to make my stop 35 ticks because I'm thinking, listen, if I'm that wrong and my timing is that bad, I'm looking for a short-term trade anyway. There's no point being involved in it. Same on a daily. I look back over perhaps the quarter and I say, well, this stock has only moved, maximum it's moved is $2. I'm going to use a $2.50 stop. And that will keep me within being right or wrong. If I'm wrong on this and I haven't really got the bottom, then I know that that's going to ping me out. So that's another way of doing it. It's kind of a systematic way. And obviously, if you're writing some algos to help you out, this is perhaps a way to start the ball rolling because it's very easy to calculate that from an algorithm than it is the premise base, which has a lot more parameters involved in it. And also from the systematic traders out there, those of you who want to trade purely systematically, make your decisions perhaps based on discretionary, but have a systematic risk management in place, then this kind of thing works very, very well.